let's start today's section. We are working on our 7th set of paper, LCCI Accounting, LCCI Financial Accounting, Level 3. September year 2019. Okay, so let's start. Okay, today our first question is not about, yes, let us go back. Okay, this is September year 2019, 100 marks, 5 compulsory questions. Question 1, okay, this time it is not extended trial balance. It is, let me change it first. Okay, it is other receivables and payables. Other receivables and payables. Okay. So let's see what we are asked to do. We are given commission received, rent and rate, and other receivables, payables, opening and closing balance. Okay, and also during the year, okay, how much are earned. Okay, and how much rent and rate are paid. Okay, be careful because here we are given 2 different things. Okay, one is earned and one is paid. Okay, rent and rate given to you. Okay, and then calculate updated profit. Okay, some accounting concepts. Okay, and then 2 marks for identification. Okay, seems not difficult. Okay, so we will work on rent and rates first. Okay, rent and rates, we have both other payables and receivables at the same time for opening and closing balance. And rent and rates paid is 10850. Okay, so other receivables go into the debit side while other payables go into the credit side. Okay, 580950. Let me write down first. 580, what else? 950. Okay, draw the format first. Okay, so not very good. 580, 950 here. Ooh. Okay, so it is for 1 year. So year 2018, 1st of June, the balance. Okay, in the debit side, it is a prepayment. While in the credit side, it is an accrual. Okay, and then we make a payment for the year, okay, year 2019, 31st of May. Okay, payment here, bank. Okay, and then we have to calculate, okay, the amount that is to be transferred to the statement of profit or loss. Okay, so this is what we have to calculate. Okay, and then closing balance. Balance carry down. Balance carry down. Okay, usually I would finish here first, year 2019, 1st of June. Balance brought down. This is the accrual. Okay, so you know it go to the opposite side back in the year end, 1st of June. balance brought down. This is prepayment. Okay, you're not asked to write what is in the bracket, but then it is good for you to write down to, you know, remind yourself. Okay, it also help. Okay, if you happen to make a mistake, okay, it will help remind you. So 70620. 70620. 700 goes into here. Okay, and then 700, okay, here, 620 here. Okay, amount you receive, amount you paid for the year, 10850 given to you. Okay, so you finish this one, 620 minus 700. Okay, so it will be 10400 finished. Okay, 7 marks. Okay, quite easy marks for you to gain. Okay, so next we have the commission received. Commission received, you have no opening balance and you have closing balance of other receivable. Okay, other receivables means that it is income in arrears, 4,500. 4,500. Okay, so yet you have no opening balance. Let me use blue. Okay, year 2019. Okay, 31st May. Receipts goes here. Year 2019, 31st of May. Okay, and then statement of profit or loss. Goes in this side. Okay, this time you're asked to calculate the amount of receipts that you have, because you are given the amount of commission earned. Okay, so you have here 4,500 receivables, right? Okay, so it is income in arrears. Year 2019, 1st of June. Okay, 4500. Okay, so let's go back. Okay, commission earned to 25,000. Okay, amount transferred to the statement of profit and loss, 25,000. Okay, so 25,000 minus this one, you have 20500. Okay, finished. Okay, the amounts that you need to find in the two accounts are different. Okay, one is for the transfer and other is for the payment. Okay, next one. Calculate the updated profit for the year. The profit was 36980 before accounting for rent and commission received. Okay, so you have the two transfer. Okay, that is 36980. Okay, the commission received, the commission income, 25,000. This is the income. Okay, and then the amount of rent and rates to be transferred, 10400. It will give you 51580. 3 marks. State the two accounting concepts that the owner has complied with. Okay, so One is, of course, the accrual concept. Accruals concept. Okay, but if you write accruals concept, you won't write matching principle for the second one. Okay, maybe also realization concept. Okay, accruals usually applies to expenses. It can also apply to income, but realization concept, it solely only applies to income. Okay, so that might be two of them. Okay, but then you can also consider, because the two concepts are very similar, if you are afraid that you can't score both, okay, let you have a reference. Okay, that is in the model answer, in the mark scheme you have, that Pearson provide. Okay, it also give prudence. Okay, but then I do not see how prudence apply to the case above. Okay, anyway, okay, that is 1 mark. Okay, you might have to take some risk. Okay, for me, I would write the 2 in red. Okay, because it directly applies to the recording of expenses, okay, and the recognition of income. Okay, next. Identify, indicating with a tick, the effect on statement of profit and loss if commission received is shown as commission paid. Okay, income is other income is shown as expense. Okay, there is no effect on gross profit, of course. Okay, but then profit for the year will decrease. Okay, because you have both income understated okay, and expenses overstated. Okay, so 18 mark finished. Next, okay, we have 1 email, 2 email, okay, some errors you have to identify, okay, and then extended trial balance, and then some other concepts. Okay, so extended trial balance, let me change. Extended trial balance. Okay, so this applies to part B and C, so we will attempt item A first. State the type of error made. A purchase of non-current asset entered into the purchase account. Of course, it would be the error of principal. Purchase invoice 100 was entered into the purchases daybook as 1000. This is error of original entry. Okay, not much difficulty. Okay, and then we have to calculate the value of inventory. Okay, value. Okay, as at year end, and then complete the extracted trial balance. Okay, inventory is not given to you, so we will put the value directly. Okay, not given to you. Okay, so let's see what is given to us in these 2 emails. From Daniel to Tien. Can I confirm that your accounting policies are still as below? Motor vehicles are depreciated at 10% reducing balance method. Full year's depreciation charged in the year of acquisition, none in the year of disposal. Okay, still as below, that means it is continuing to be like this. Okay, so later when you are asked about the accounting concepts, okay, most probably you will cite consistency. Okay, next one, the allowance for doubtful debt is maintained as 5% trade receivables. Okay, good information given to you about depreciation policy and allowance for doubtful debts. Okay, and our reply to Daniel, thank you for your email. Yes, there are still these are still my accounting policies. In addition, on the 1st of January, I purchased new motor vehicle costing 30,000 to replace the existing motor vehicle, which was traded in. Oh, we have trade in the first time in the questions that we attempted. Traded in for 20,000. I financed the balance by a 10% bank loan. Okay, that means it would be a bank loan being 10,000. Okay, with interest paid on the 31st of December. Okay, and our the loan is borrowed on the 1st of January year 2019. Before we do anything, let us go to see our year end is on the 30th of June. Okay, so that means we have borrowed it for half an hour and haven't paid any interest yet. So let us calculate. It will be 10,000, 10%. Okay, 10,000, 10%, and then half year. This will be your interest accrued. Okay, so it will be 500 interest. I have valued inventory at 25400, including damaged item 54,000, which can be sold for 6,000 after repairs costing 1,000. IAS2 inventory should be valued at lower of cost, or NRV, okay, being 6,000 minus 1,000. Okay, that is 5,000 NRV. Compare the cost with the NRV. We have an impairment of 400. Okay, that means this 25,400. Okay, we need to minus 400, and that will give you value of inventory being 25,000. Okay, so let's see here. Value of inventory 1 mark, so we have calculated. Just put it there. Okay, so I wonder if the disposal is being recorded. Let us see. Okay, so let us go to motor vehicle first. Okay, so motor vehicle, there's only one motor vehicle, and then we have traded it in. That means, okay, we will do something like this. Motor vehicle, okay, this is in the debit side, the accumulated depreciation in the credit side. So when we need to dispose it, okay, 27500, and take away all the accumulated depreciation. Do we have any disposal account? Yes, there is. Okay, so 27500 here. Okay, and then the credit side we will have 25225. Okay, that is the accumulated depreciation 5225, and then the trade-in allowance, okay, 20,000. We have purchased new motor vehicle costing 30,000. Okay, and the bank loan 10. Okay, so you can see the 30,000 is financed by, okay, this 10,000 bank loan and also the trade-in allowance here. Okay, so next we will calculate the depreciation. Let us go back and see the depreciation policy. 10% reducing balance. 10% reducing balance. Okay, so the old motor vehicle is disposed of, so the only item that remains will be 30,000. Okay, 30,000. So depreciation will be 3,000. Let me use red, okay, to finish with all the items. related to non-current asset. Okay, and depreciation here, 3,000. Okay, finish. Finish for motor vehicles. Okay, what's next is I will also like to deal with the loan interest. Okay, because we have borrowed loan, 10% loan, and then half-year interest accrual. So other payables 500. Okay, sorry, other payables would be here 500. Okay, because it is in the credit side, and bank loan interest expense would be 500 debit side. Loan interest expense is an yes, it is an expense, so it goes to the debit side. So next, how about we deal with inventory? Okay, inventory is easy because we have calculated the value of inventory to be 25,000. So let us just enter the value into the extended trial balance. Closing inventory, statement of financial position. So it is an asset, so it will be in the debit side 25,000, and then in the statement of profit and loss as a negative amount, okay, of being the closing inventory, okay, in the cost of sales, which is also a negative amount. So negative, negative, positive effect on income, credit side. We only have one item left, okay, that is the allowance for doubtful debt. Trade receivables 11500, let me use another color, 11500, 5%, 11500, 5% being 575. Okay, it is lower than the opening balance. Allowance for doubtful debt is a credit side account. If you want to reduce it, okay, then you debit 765, and then allowance for doubtful debt adjustment, it become an income. So 765. Okay, finished. How many marks? 14 marks for this extended trial balance. Next, state the accounting concept that apply when a business maintains the same accounting policies. Of course, it will be consistency. Explain one reason why TN uses the reducing balance method to depreciate her motor vehicle. For motor vehicle, the most suitable accounting method for depreciation is, of course, the diminishing balance method or reducing balance method. Okay, but then 10% is not enough for me. Okay, 10%, it means how many years do you need to depreciate to zero? Okay, maybe 20 years. Okay, a car for business use, okay, maybe it can't run for 20 years. Okay, so explain one reason. Okay, why? Okay, so usually, okay, for motor vehicle, okay, reduce sharp reduction in value in early use. Okay, that's why, okay, we use reducing balance method, because, okay, in early years, okay, depreciation will be higher. Okay, so this is one of the reasons that you can give. Another reason is, okay, you can also think of the cost of usage. Okay, cost of usage. Okay, that is because for motor vehicle, in the early years, okay, you have lower maintenance costs. Okay, lower maintenance costs match with higher depreciation. Okay, while in the later years, you have higher maintenance plus lower depreciation. Okay, and that would balance your cost of using the motor vehicles, and it would not distort your statement of profit or loss. Okay, it would not distort your profit for just keeping a motor vehicle and using it. Okay, so both are okay. Okay, I think for the first one it is more obvious. The second one, you look at the it is deeper. Okay, you go deeper on the analysis. Okay, but then it's just 2 marks. Okay, so question 3, partnership. Okay, let us take a look a little bit before we dig deep. So we have Homer and Bert. Okay, and then Bert left the partnership. Getty joined. Okay, one leaving, one joining. Okay, we have to prepare the capital account of Bert, calculate the balance of Getty's capital account upon entering the partnership. Okay, and then appropriation account for the 9 months for Homer and Getty, and some explanation, and then statement of financial position, equity section. So year end is when? Let us take a look. Year start is 1st of April, year 2018, giving you a year end of 31st March, year 2019. Okay, let us read on. Originally, the partner share profit and losses equally. Opening balance of capital and current account balances. Bert have a debit balance, okay, that is negative. And on the 30th of June, year 2018, okay, that is 3 months afterwards. 3 months only. Bert left the partnership and agreed to leave 75,000 of the amount due to him as an interest-free loan to the new partnership, with the remainder being settled by check. Okay, very generous, interest-free loan. Getty joined the partnership. She introduced capital of 100,000, which included a motor vehicle valued at 25,000. The new partnership agreement provided for profit and losses shared equally, interest at 6% per annum on opening balances, and annual salary 11600 for each partner. Be careful, okay, for the new partnership you only have 9 months for this year. Okay, 9 months. Non-current assets were revalued upward by 60,000, goodwill valued at 40,000. Partners agree not to maintain goodwill in the books. Profit for the year 65,000, which was earned evenly. Okay, so let us take a look. Capital account of Bert, okay, and of course upon leaving the partnership. Okay, let's see. Let us draw the format first. Oops. Why does it jump like this? Okay, year 2018. 1st of April. Opening balance. Okay, for Bert, the capital account is 100,000. Okay, so next I will also put the revaluation and also the adjustment of goodwill first. Okay, so 30th of June, revaluation and goodwill. So let us see. Okay, at non-current assets revalued upward by 60 and goodwill was valued at 40. So they share the profit and losses equally. So the revaluation will give 30,000 increase to Bert and 20,000 for goodwill. Okay, and then we also have to transfer the current account balances here. Okay, the current account balance for Bert would be 5275 negative, but then we also have to share the profit. So let us see, 65,000 for 3 months. Okay, it would be 65,000 times 3 divided by 12. Okay, it would be 16250. Okay, shared equally divided by 2. It would be 8125. Okay, so it will give you a positive balance of 2850. Is there any drawings mentioned? Okay, no drawings. So current account would be 2850 positive. 2850, 30th June, current account of Bert. Okay, these are all the money that Bert has in the business. Next, he will leave 75,000 here as the loan. So 30th June, loan from Bert. And then the balance will be paid through the bank. Okay, so 150,000 0 minus 75,000. It would be 77,850. Okay, this is the final settlement for Bert. Calculate the balance of Getty's capital account on the 1st of July. Okay, this is the first day of the new partnership. She is taking in 100,000. Okay, 75,000 bank and also 25,000 motor vehicle. Okay, and then what we need to do is reduce the amount from goodwill written off. That is 80,000. Okay, next. Appropriation account for the 9 months. Okay. So first of all, okay. We have 65,000 And for 9 months, okay, it will be 48750. Okay, this is profit for the 9 months. Okay, appropriations. So we have Homer and Getty. Okay, so the annual salary will be 11600 for each partner. So 11600, remember we only have 9 months. Same for both partners. Okay, it will be 8700 for each of them. So 17400. Okay, next will be interest on capital. There is interest on capital, right? Interest on capital, yes, 6% on opening balances. So add less interest on capital. Okay, Homer and Getty. Okay, let us deal with Getty first because we know, okay, 80,000, okay, 6%, and then 9 months. 36,000. And then for Homer, let me see. Homer. Okay, for Homer, originally, okay, he has this one, okay, and then just like Bert, okay, the assets revaluation 30,000, and then goodwill 20,000, but afterwards we also write off goodwill 20,000, so it will give you 1300, okay, as the opening balance on the 1st of July. Okay, so 130,000, 6%, 9 months. $5,850 plus 3,600, 9,450. Okay, negative here, be careful. Okay, don't miss out the important bracket. Okay, so 94875017400, and then 9450. Okay, it will be 21900. Okay, that is profit available for distribution. And then share of profit, okay, equally between the two partners, Homer and Getty. Okay, so divided by 2, we have 10950. Okay, finish. How many marks? 5 only. Wow. Explain one reason why the new partnership agreed to allow interest on capital. Okay, it is okay to compensate for alternative investment option, because if they do not invest in this business, okay, they can take cash to invest in other businesses and get interest. Okay, so this is one of the reasons. Another reason I can think of is, why do we not have the interest on capital before, but now we have that? Okay, because before, this Homer and Bird, they are giving the same capital, same amount of capital, but now, Homer's capital is greater than Getty's capital. Okay, so it would be fair to compensate the investors according to how much they invest in the company. Okay, so next one, we have to, what do we have to do? Okay, we have to give the equity section of Homer and Getty. Okay, so you have 2 ways to do it, okay, either in a horizontal way or a vertical way. Okay, so I show you here. Okay, how about we use the vertical way? Okay, like this. Okay, we have Homer, Getty, and total. Okay, and we have capital here and current account, okay, and then total. Okay, so for capital, okay, just now we have already calculated 13,000 for Homer, okay, Getty 80,000, okay, and the total being 210,000. Okay, current account is a little bit more complex. Okay, and let's do workings here. Originally, Homer has 75,000, and in the first 3 months, 8125. Okay, so here, 75,8125. Okay, that is on the 1st of July. Homer will have 15625. Okay, and then Getty do not have, because it's just start of the new partnership. Okay, and then next one, okay, we have to look at the appropriations for the 9 months. 88,700 5850, 8,700. What? I forgot. 5850, 5850, and then 10950. Okay, and for Getty, 8,700, 3,600, and then the same amount for the share of profit. For 1125. Okay, so we're finished here. 41125, 23250, 64375. Okay, and here we have 171125, and then this. Okay, 19 marks here. 3 questions down. Okay, we have 2 more. Okay, give me a short break. Thank you. Let's come back. Next, we will have question 4. Okay, it looks like single entry, but can be a single entry, and complete the statement of financial position, 14 marks for this sole trader. So I will still classify it as sole trader. Okay. Okay, and some discussion questions. Let's see. So this Elso provided the following information for his new business for the year ended 30th June, year 2019. 1 year ago, Elso rented premises at an annual cost of $24,000. 1st of October, that is 3 months afterwards, Elso acquired non-current asset costing $130,000. This was funded by a 5% loan, repayable in full within 12 months, and personal funds of $20,000, and the business and the balance from the business bank account. So how much? Okay, I see. Here we can see that the opening equity, the initial investment, 40,000. Okay, and non-current asset, 30,000. So this 130,000, okay, is funded 3 ways. Okay, 30,000 from bank. Okay, and also personal funds of 20,000. Okay, that is added to capital, and that is 8,000 of 5% loan. Okay, repayable in full within 12 months. So by the end of the year, it will be a current liability. Okay, and for 9 months, interest accrued, 80,000, 5% loan, and then accrued for 9 months. Okay, interest being 3,000, and there's no interest payment, you can see. Let me calculate one more time. 80,000, 5% loan, and then for 9 months, yes, 3,000. Depreciation is charged on all non-current asset, 10%, strict line method, monthly basis. Okay, so depreciation, 130,000, 10% for 9 months. Depreciation being 9,750. Okay, and also buy and sell goods on a cash and credit basis, gross profit margin 50%. Cash banked, cash banked 4,996, trade receivable 100,000, drawings, general expenses, rent. Okay, rent, how much? Rent, annual rent would be 24,000. There is a prepayment of 2,000. Trade payables 54750. During the year, total purchases, total sales, including cash sales. Okay, that is interesting. Okay, so total sales and then purchases. Okay, and I think you have to calculate the closing balance of inventory? Oh, very interesting question. Let us work on the trading account. Okay, so if you have 170,000 here, okay, and 50% profit margin, okay, that would give you 85,000 for cost of sales and 85,000 for gross profit. Okay, I think later you can also calculate net profit if that is the case. Okay, let me write down here. Okay, good. So you have purchases with a total of 90,000, okay, and that will give you 5,000 of closing inventory. Oh. Okay, so that is one item that you need for your statement of financial position. Cash was spent after paying general expenses of 7868, purchases of 12580, and retaining a float of 150 and drawings. Wow. Okay, so you have cash sales of 33,000. And you have 7868 for general expenses. Okay, purchases 12850. Okay, payment. Okay, and then drawings. Okay, and that would, one more item, drawings. And you have cash banked. Okay, this drawings is one item that you need to find. Okay, cash bank 4966, and that gives you a cash float of 150. So let's see, 7868, 12850, 4966, and 150. That would give you cash drawings of 7166. Let me calculate one more time. 33,000. 950, 7166, 4966, 150. Yes. Okay, so you need the amount of drawings. Okay, let me draw a better heart. Interesting. Okay, and you also need trade receivables and trade payables. Okay, trade receivables is a little bit easier because you have this. Let me see. Total sales. Total sales 170, 33 being cash sales. So credit sales would be 137,000. Okay, and then receipt of 10,000. That will give you trade receivables of 37,000. That is trade receivables. How about trade payables? Okay, we'll use the same way. Trade payables, total purchases being how much? 90,000. and you have cash purchases of 12850. That give you credit purchases of 77150. Okay, I better use the calculator. 77150, yes. And then you have paid 54750 trade payables, being 22400. Okay, I hope we get it all correct. Okay. Yes. Yes. Okay, we can also finish calculating the net profit. Okay, interest first. Okay, 3,000 interest, depreciation 9750. That is what we calculated before. General expenses, we have 27650, plus we have some general expenses paid out of cash. Okay, that would give you 35518. Rent 24,000. Okay, I think that's all. Okay, 3,000, 9750, 35518, and then 24,000, 72268, and then net profit 12732. These are all your workings. Okay, and then when you finish, okay, it will be quite easy. Okay, one more item before we go on. Okay, that is, I want to calculate the amount of cash we still have. Okay, 40,000, 4966, 100,000, 75, 650, 26, 30,000, 54750. So you have bank overdraft of 934. Okay, one more time. Yes. Okay, bank overdraft 934. Okay, you are told here as well. Okay, cash and cash equivalent being the cash. Okay, so now we can fill in. Non-current asset, we have depreciation of how much? 9750. Okay, so here, 9750, 130,000. 9750, 1020250, non-current asset. Okay, inventory, let us go back. 5,000, trade and other receivables, 37,000. 5,000, 37,000, is it? 39,000, because we have trade and other receivables. 37,000 for trade receivables, plus 2,000 for prepayment. Cash and cash equivalent, we have 150 cash float. Okay, total asset. Okay, if you are given like this, then you should do something like this. Okay, 5,000, 39,150, 44150, plus 120,250, 164400. Okay, next part, equity. You begin with 40,000, and then additional equity for the purchase of non-current asset. Profit for the year 12732. 12732. Drawings. Okay, here drawings, you have drawings from the bank 7,500 here, plus another drawing 7166, 7166. Okay, 14666, 14666. Total equity. Okay, you are drawing more than your profit. Okay, next one, trade and other payables. We have interest accrual. Okay, be careful. So trade payables 22400, and then interest accrual 3000. Okay, so 3000 here. Trade payables 22400, so that will give you 25400. Okay, bank loan 80,000 current because it is payable in 3 months time. Bank overdraft would be 934. 934. Okay, so let's see if we can balance 80,000, 934, 106,334 plus 58066. Yes, 164400. Finish. Okay, how many marks? 14 marks for this part. Okay, not very difficult, but then you have to know, okay, when you are given those information, what you need to find. Okay, if you just work on the statement of financial position item by item, okay, you will easily miss some. Okay, because my way is I deal with all the information given to me, okay, and then work out the items I think are available from the information, okay, and then look at the statement of financial position to see if I missed anything. Okay, like when I work on trade and other receivables, I almost miss out the prepayment, but then when I see, well, there is not another line for other receivables, then I remember I still have a prepayment to put in. Okay, that's the way. If you work out item by item, you will surely miss some. Okay, so next one, discuss whether also should employ a financial accountant. Justify your decision. Well. Okay, first thing, okay, it is using single entry. Okay, that is not double entry. Okay, cannot check the error. Okay, cannot identify any error because there's no trial balance. Okay, not giving you real-time or immediate access to information. Okay, so if you employ financial accountant, okay, then can settle these drawbacks. Okay, and can also free also from accounting duties. Okay, and that would give also more time to work on buying and selling. Okay, the operations, which I think he would be better in. Okay, but of course, okay, employing means salary, and that will go into your costs, okay, or expenses, and that would reduce your net profit. Okay, you have to see that this also is not making that much of profit. Okay, if he is to employ someone, okay, if the time that is freed up cannot compensate the need to pay salary to the financial accountant, then it is not worth it. Okay, so what I see is, okay, you better first make sure your business is making good profit. Okay, expand. Okay, and then when he cannot deal with accounting, okay, when he's too busy, then employ someone that is professional in this field. Okay, so next one, state 3 stakeholders who might be interested in the accounts of Lv3. Okay, always when I see 3, okay, make sure you give 3 parties that are distinct from each other. Okay, for example, here I would say, first of all, government. Okay, I would also say potential investors. Okay, because he is now working alone. Okay, maybe he can find a partner to join and form a partnership. Okay, and I say here partnership, to form a partnership. Okay, and usually I will also say the competitors. Okay, they are distinctive enough. Question 5. Question 5 is the statement of cash flows. Okay, as always, statement of cash flows. Okay, so you are given opening and closing balance 30th June. Okay, and then calculate total depreciation and then reconciliation of profit to net cash from operating activities, first part of the statement of financial position. Okay, and then you are not asked to work on the other items. Okay, calculate the amount of the bank loan. Okay. State 2 other methods of funding the purchase of machinery. Okay, you might issue some shares, you might have issue debentures, okay, other than the bank loan. Calculate the following ratios. Okay, we need to calculate. Before, we might just have to look at the ratios and comment. Now we have to calculate and then evaluate the change in liquidity using only the data provided. Okay, so we cannot make up anything from our imagination. So let's see. What first? Depreciation. Okay, and then the reconciliation. Penn Limited provided the following information. Okay, revenue for the 2 years, profit for the year. Okay, and then machinery, the cost and accumulated depreciation, inventory. Okay, if there is no adjustment on inventory, I would calculate the change first. Okay, so it is 5200 negative. Okay, so operating trade receivables 8700. If there is no adjustment, increase operating negative. Trade payables 7500 4750 2750 decrease negative. Okay, so depreciation, let me write it better. The cost, the accumulated depreciation, year 2018, year 2019. Okay, we have 225000, 31000, okay, 57400, 53750. Okay, so machinery costing 50,000 was sold for 25,000. this machinery had accumulated depreciation of 28,400. Okay, so we have here, okay, remember for the cost we have purchases minus disposal. Okay, no revaluation here, so no problem. Okay, plus depreciation minus disposal. Okay, always like this. If it is carrying value, then the two will combine. So for disposal, I would input the figure. It costs you 50,000 with accumulated depreciation 28,400. Okay, and here purchases given to you 135,000, partly financed by the long-term bank loan. Okay, so we'll see. Okay, let us calculate if it is correct. 225,135 minus 50, 310, correct. Okay, and then we have to calculate depreciation here. Okay, 357,400, 284. Okay, minus this one. Okay, we have 24750. Let me check again. 57400, 245. Yes. Okay, so 24750. 24570. Okay, 1 mark, so no need for workings. Next, I will also work on the disposal gain loss just like before, so I'm not going to give the wordings anymore because we have been dealing with that for a lot of times already. Okay, so 25,000 for the proceeds, and then 50,000 the cost, 28400 accumulated depreciation. That will give 21600 as the carrying value. Okay, and we have 3400 as the disposal gain. Here, disposal gain go into operating activities negative, purchases, investing activities negative, and then depreciation for the year, operating activities positive, and then this. Okay, remember we have two figures for non-current asset, okay, that will happen, that will appear, and then two more if we have the disposal of non-current asset. Okay, so do we have to calculate how much is paid for the how much is borrowed? I guess so. Calculate the amount of bank loan. Okay, so we'll deal with it later. Let us go on to the reconciliation first. Okay, if we need it, it means that we have to work out the whole thing, but then not in the format. Okay, so we start with net profit for the year, 53,000. Okay, this is the net profit. Okay, adjustment for, okay, add depreciation less depreciation, disposal gain. Okay, disposal gain being 34,000 if I remember correctly. Okay, depreciation is 24570. Okay, and that would give you 24570, 34,000, 21170, 4170. Okay, and then we have add decrease in inventory less increase in trade receivables less decrease in trade payables. And we have already worked out the 3 items, but I forgot. Okay, 5200. Okay, 5200, 8700, and then 2750. Oops. And then we finish. Six, 250 here. 6. Okay, wait. Here, 1. Okay. What happened? 13700. Okay, why I get the wrong number? One 3700. Very risky. 11250 plus 2 4 3 5200. Okay, let me calculate one more time. 2 5 2 4 7 5 0. Oh, what happened? Ayo. I am too careless. Okay. 2 4 7 5 0. 2 1 3 5 0. Yes. 7 4 3 5 0. 1 3 5 0. Okay. Let's look like it. Okay. So this is net cash from operating activities. Okay, sorry for making these careless mistakes. Next part, we have to calculate the amount of bank loan. Okay, how are we going to do it? It's actually we work on the whole statement of financial position, because you look at here. No issues of shares, no dividend. That means financing activities is only for the bank loan. Okay, investing activities, we find the 2 investing activities items: purchase and also disposal. We have operating. Okay, we have the cash and cash equivalent, and also bank overdraft. Okay, so let us see here. From a bank overdraft to cash and cash equivalent, that means we have increase in cash and cash equivalent of 4850. Increase in cash and cash equivalent 4850. Okay, so here I would like to do this. Okay, that is 63100. Okay, let me draw a format. Okay, operating activities, cash flow 63100. Okay, and then investing, because we don't need a statement of cash flows, that's why I would do something like this. Okay, we add proceeds from disposal less purchase of non-current asset. Okay, let's see how much. 25,000, I guess. Okay, purchase we need to see. For the purchase, it is 135,000. 135,000. Okay, so negative. So it would be 110,000 negative. Okay, and then we have to calculate the bank loan, and then we have the increase in cash and cash equivalent. Okay, the increase being 4850. So I guess it would be like this. Okay, 63100 minus this one. Okay, so we have minus 484. I think it would be 51750. Okay, like this. Okay, let us calculate one more time. Minus 11,000 plus. Yes. Okay, so this is the cash flows from financing activities, and also this would be the amount for bank loan. State two other methods. Okay, just like I said, we can have a share issue. Okay, we can issue also debentures. If we look at other ways to finance, okay, remember we still have other ways other than borrowing money, increasing capital. Okay, we can have hire purchase. Okay, we pay bit by bit. Okay, we can have leasing. Okay, something like this. Okay, we don't need to pay for one time. Calculate the following ratios correct to 2 decimal places. Okay, profit for the year as a percentage of revenue. Okay, so given to you directly the profit and revenue, so it's not difficult. Let me move the thing first. Where is it? Okay. Here, sorry. Page 17. Okay. So revenue 334, profit 53. Profit for the year 53,000 over 334,000, 100%. Okay, we don't need to show the workings. okay, because there is no mark for it, okay, but then you can still give it, okay, because if you need to check your answer, okay, it would be good. Okay, next one, return on capital employed. Okay, return on capital employed, then you need this net profit. Okay, let's see. Okay, you do not know interest. Okay, that is, you assume that it is, you know, borrowed in the last day. What, you don't have anything? You don't have ordinary shares. How do you know? How? Okay, I know. You have to do something like this. You have to calculate your own equity with the information given to you, because you have, you see, non-current asset, inventory, trade receivables, cash and cash equivalent, and then yes, okay, so you have to do that. Okay, why just one mark? Okay, 30, 300 and okay, so you have, okay, let me use red, 256250 plus inventory plus receivable 18 plus cash and cash equivalent. So total asset, you have 296350. Let me calculate one more time. Yes, okay, and then liabilities, you have 4750, as well as the bank loan 51. Oh no, bank loan is long term. Okay, so this one is good. So 22965 minus 4750, you have 2291600. This is the best that I can get, I think. Yes, 219600. That would be your equity plus long-term non-current liability, 219600. Okay, 219600. Capital employed. Okay, are we given anything? Yeah, I think that's all. Okay, but no interest. long-term bank loan. I think that's all. Let me calculate one more time. 310 minus inventory. Cash and cash equivalent. Yes. Minus. Two 91600. Okay, what happened? Okay, so that would give you 18.18%. Okay, next. Assets turnover based on total assets. Okay, total assets we have calculated to be this. Uh, 296350. Okay, 296350. 296350 divided by turnover. Okay, that is 334,000. 334,000 divided by 296350. It will be 1.13 times. Okay, so I hope you are okay with it. Next 3 marks taking me much time. The last 5 marks. Evaluate the change in liquidity of Pan Limited using only the data provided. Okay, so if this is so, then we look at a few things. Okay, first of all, bank overdraft turns into positive cash and cash equivalent. Okay, because of different things. Okay, like inventory, trade receivables. We are not going to calculate the current ratio. You can, okay, but we do not need to. Okay, because these are still the information given to us. Okay, you have inventory, trade receivable, trade payables, cash and cash equivalent, overdraft. Okay, you can calculate. Oh, it might be good for us to calculate. Okay, maybe we do that as well. Let me use screen. Here we have 30,000. Okay, divided by 73250. That is 10750. 30,000 divided. Okay, that is 2.8, 2.7921. Okay, how about closing? 198001 plus 16,000. That is 40100 divided by this. Okay, so it becomes close to 10 times. Okay, 8.44 to 1. Okay, so you can see, okay, of course the liquidity improved. We can see increase in cash and cash equivalent, most of it from the profit, okay, and then from depreciation. We have saved some money on inventory, okay, but then the trade receivables become a little bit worrying because you can see you have less revenue. Okay, and then why do you have a lot more trade receivable? That doesn't make sense. If you are making much more revenue, then it is possible, but then you are not. Okay, given that you have decrease in revenue, okay, you should have decrease in trade receivables too. Okay, but then there is a sharp increase, so that is a problem. Okay, so here, okay, if it says only, okay, your current account, I mean your current ratio is just for your own reference. Okay, so overall I can see there is an improvement because cash and cash equivalent increase. Okay, 4850 from bank overdraft to positive balance. Okay, but then okay, we can see that okay, it is very worrying for trade receivables. Okay, sharp increase. You are not collecting from them. They keep your cash, our cash. Okay, liquidity problem. Okay, also possible of irrecoverable debt. Okay, the risk of it. Okay, another better point is for inventory. Okay, good, less cash locked in inventory. Okay, so overall it is still good. Okay, I can say that 5 marks. Okay, so thank you for joining me for revision. Okay, see you soon.